Hello everyone, welcome back to the channel. Today we are diving into the Indian markets. The Sensex and Nifty have seen significant declines and the reasons behind the market slump are more complex than they seem. Let's break it down. On 13th January, Indian blue chip indices, that is the Sensex and Nifty, both took a severe hit. The BSE Sensex dropped over 1,100 points, hitting a low of 76,250, whereas the Nifty 50 slits 350 points, reaching 23,047. This downturn wiped out rupees 14.54 lakh crore in market capitalization across all the BSE listed companies, pushing the total market value down to rupees 416.08 lakh crore. So what caused this massive crash? Let's take a closer look at the key factors fueling the Sensex crash today. Firstly, US economic data and Fed rate outlook. The US jobs report released last Friday shocked the global markets, fueling the fears that the Federal Reserve may delay its anticipated rate cuts. The US unemployment rate fell to 4.1% in December, with a robust job growth suggesting that the monetary easing is less likely in the near term. This has also led to the tighter global liquidity, placing the additional pressure on emerging markets like India. Secondly, persistent foreign selling. In fact, your foreign portfolio investors have continued their aggressive selling of Indian stocks. In January alone, if we look at the data, then FPIs have sold equities worth over 21,350 crore, following the 16,982 crore outflows in the month of December. This sustained selling pressure is attributed to the concerns over the stretched valuations, disappointing corporate earnings, and the rising US bond yields. In fact, crude oil prices surge has also put some pressure. Global crude oil prices soared to a 15-week high amid the new US sanctions on Russia, which could disrupt the global supply chain. As a major importer of oil, India is particularly vulnerable to rising crude prices, which can strain the fiscal health and exacerbate the inflationary pressures, further adding to the investor anxiety. Another reason is weakening rupee. To add to the pressure, the Indian rupee has hit a record low of rupees 86.27 against the US dollar. With the US dollar strengthening, this further compounds investor anxiety. The weaker rupee not only makes imports more expensive but also adds to the strain caused by the capital outflows. So when the rupee weakens, it creates a vicious cycle, pushing even more investors to pull out. Another reason that it can be attributed is global market sell-off. Asian markets mirrored the weakness in US equities, with the MSCI index of regional stocks heading towards its fourth consecutive day of losses. In fact, the strong US economic data has dampened the expectations of Federal Reserve rate cuts, leading to a broader global sell-off in both equities and the bonds. The combination of the domestic pressures such as the weakening rupee and foreign outflows, along with the global headwinds like higher crude prices and tighter liquidity, has created a challenging environment for the Indian markets. Another reason that can be attributed is bond yields. If we talk about it, then the 10-year US Treasury yield surged to 4.73%, its highest level since the month of April. Following the release of strong job data and robust service sector performance, analysts now expect the Fed to hold rates steady in the month of January, further strengthening the dollar and pushing the bond yields higher. In fact, if we talk about the earnings downgrade, then after 4 consecutive years of strong double-digit growth, Indian corporate earnings have started to slow, with analysts downgrading the earnings projection for the last 2 quarters. Quarter 3 results are unlikely to offer positive surprises, according to the experts, and the brokerages are also forecasting single-digit earnings growth for the full year financial year 2025. So these were some of the reasons which has dented the Indian markets today. With that, it's a wrap. For more such updates, keep watching moneycontrol.com and please like, share and subscribe to Money Control's YouTube channel.